Most people think the financial dangers of life become smaller after age 50. You may have spent decades building a career. Your income may be higher than it was in your 20s or 30s. Your children may be older, your mortgage may be smaller, and retirement, once a distant idea, may finally feel close enough to imagine. So the assumption seems obvious: after 50, money should become easier. But the real answer is far stranger. For many people, age 50 is when one of the most dangerous financial traps quietly begins. It rarely looks like a crisis. It does not arrive as a dramatic stock market crash, a sudden bankruptcy, or one terrible purchase. Instead, it arrives disguised as comfort. A nicer car feels reasonable. A larger vacation feels deserved. Helping adult children feels necessary. Renovating the house feels practical. Eating at better restaurants feels normal. And because your income may be near its lifetime peak, none of these decisions immediately feels dangerous. But what happens when a lifestyle built on peak income continues after that income disappears? That is where the trap begins. Economists use a concept called lifestyle inflation to describe what happens when spending rises alongside income. You earn more, so you spend more. The process feels harmless because your bank account may still remain positive. You are not necessarily drowning in debt, you may even be saving money. But your definition of normal is becoming more expensive. And your brain is remarkably good at adapting to improvements. Psychologists call this hedonic adaptation. When something good enters your life, the excitement usually fades. A new car feels extraordinary for a few weeks, then it becomes your car. A luxury hotel feels special the first time. Eventually, anything less begins to feel disappointing. Researchers Philip Brickman and Donald Campbell helped popularize this idea through the concept of the hedonic treadmill. The basic insight is uncomfortable. As your circumstances improve, your expectations often rise with them. You run faster financially, but the feeling of satisfaction does not necessarily move forward. And after 50, this can become especially dangerous. Why? Because time is changing. At 25, a financial mistake may have decades to recover. At 35, there may still be 30 years before traditional retirement age. But after 50, every dollar has less time to compound, and every permanent increase in spending creates a larger burden on the future. Imagine that you spend an extra $1,000 every month after turning 50. It may not feel dramatic, especially if your salary has increased. But that is $12,000 a year. Over 15 years, that becomes $180,000 before considering any potential investment growth that money could have produced. The real cost is not just what you spend. It is what that money could have become. This is where compound growth creates a strange financial asymmetry. Money invested earlier has more time to multiply. Money spent later may seem less dangerous because retirement is closer, but the opposite can be true. You have fewer years available to replace it. Research by behavioral economist Richard Thaler showed how mental accounting affects financial decisions. Your brain does not always treat every dollar equally. A bonus may feel like fun money. A tax refund may feel like free money. A raise may immediately become permission for a better lifestyle. But money does not know where it came from. A dollar spent from a bonus is still a dollar that cannot protect your future. And after 50, another psychological force enters the picture. You may feel that you have earned the right to enjoy yourself. That feeling is understandable. You may have worked for 30 years. You may have delayed vacations, raised children, paid bills, survived recessions, handled emergencies, and watched younger versions of yourself sacrifice comfort for stability. So when more money finally arrives, your brain produces a powerful argument. You deserve this. But can something be deserved and still be financially dangerous? That is the uncomfortable question. The trap is not enjoying money. The trap is turning temporary peak earnings into permanent lifestyle requirements. A premium car becomes a recurring expectation. Expensive travel becomes the new baseline. A larger house brings larger taxes, maintenance costs, insurance, utilities, and repairs. Financial support for adult children may continue without a clear ending. One decision becomes a system. And systems are harder to reverse than purchases. This becomes especially important because income does not always decline gradually. Retirement can create a sudden cliff. One month, a paycheck arrives, the next month it does not. Your expenses, however, do not automatically understand that you retired. The house still needs maintenance. Insurance still costs money, cars still need repairs, food still has a price, property taxes continue, medical expenses may rise, family members may still ask for help. The lifestyle remains. The paycheck disappears. Research into retirement spending has revealed another surprising pattern. Economists Michael Hurd and Suzanne Roeder studied how household spending changes during retirement and found that spending behavior can shift significantly when people leave the workforce. But your ability to reduce spending depends heavily on what kind of lifestyle you built before retirement. Some expenses are easy to cut, others become emotionally difficult. Canceling one subscription is simple. Selling the home where your family created decades of memories is not. Skipping a restaurant is easy. Telling an adult child that financial support must end can be much harder. And that reveals the deeper danger of the trap after 50. Your spending becomes connected to identity. The car may represent success, the house may represent achievement, the vacation may represent freedom, supporting family may represent love. So reducing expenses can feel like losing pieces of yourself. Your brain does not experience the decision as mathematics. It experiences it as loss. Psychologists Daniel Kahneman and Amos Tversky demonstrated this through prospect theory. One of their most influential findings was that losses often feel more painful than equivalent gains feel pleasurable. Losing $100 can hurt more than gaining $100 feels good. Now apply that to lifestyle. Moving from an ordinary car to a luxury car feels exciting, but returning from the luxury car to an ordinary one may feel far more painful. Upgrading is easy. Downgrading is psychologically expensive. That is why lifestyle inflation after 50 can become a one-way door. But there is another force hiding beneath the surface. Social comparison. You may look at friends, coworkers, neighbors, or relatives who appear to be doing better. Someone buys a vacation home, someone travels internationally 3 times a year. Someone drives a new luxury SUV, someone posts photographs from expensive restaurants. And your brain quietly adjusts its definition of normal. The economist Thorstein Veblen described conspicuous consumption more than a century ago, spending partly used to signal status and social position. Modern technology has made that comparison nearly constant. Your ancestors compared themselves with a relatively small group. Your brain now has access to thousands of carefully selected images of other people's best moments. You rarely see the retirement account behind the vacation photo. You do not see the car loan behind the new vehicle. You do not see the credit card balance behind the restaurant table. You see the lifestyle. And your brain compares. But what if the people you are trying to keep up with are also trying to keep up with someone else? That creates a financial race with no finish line. After 50, another trap can appear through generosity. You may want to help adult children with rent, education, weddings, cars, homes, or emergencies. Helping family can be deeply meaningful, but generosity becomes dangerous when it requires sacrificing your own financial independence. Why? Because your adult child may have decades to earn money. You may not. A 25-year-old can recover from a financial setback with 40 years of future income. At 60, the recovery window is much smaller. Yet emotionally, saying no can feel selfish. This creates a painful contradiction. You may protect someone else's present by weakening your own future. And if your retirement savings eventually run out, the same family you tried to help may later need to support you. The trap completes a circle. So what actually protects you? Not extreme deprivation. Not refusing every vacation. Not living as if enjoyment is forbidden. The answer is separating temporary income from permanent lifestyle. When earnings rise late in your career, the most powerful question may not be, what can you afford today? It may be, could you comfortably maintain this after your paycheck disappears? That single question changes the meaning of affordability. A car is not affordable merely because you can make the payment. A house is not affordable merely because a bank approves the mortgage. A lifestyle is not affordable merely because your current salary can support it. True affordability includes the future version of you. And this is where age 50 can become either a trap or an opportunity. Your peak earning years may be the final great acceleration period for building financial independence. Retirement accounts may grow faster because the balance is larger. Debt can be eliminated. Fixed expenses can be reduced. Lifestyle can be intentionally designed around freedom rather than appearance. The same decade that creates financial danger can also create extraordinary resilience. But only if your brain recognizes the trap. Because your brain was never designed for retirement. Your ancestors did not stop working at 65 and fund 30 years of life from investment portfolios. Your brain evolved to prioritize immediate resources, social status, family protection, and present comfort. Those instincts once helped your ancestors survive. Today, they can convince you that a higher salary means a permanently higher standard of living. And that may be the strangest financial danger after 50. You can earn more money than ever before, look more successful than ever before, and feel more comfortable than ever before while quietly becoming less prepared for the moment your paycheck stops. The trap does not begin when you run out of money. It begins years earlier, the moment your brain turns today's peak income into tomorrow's minimum requirement.